Hello everyone and welcome to Financial Accounting. In this video we're going to be going over Chapter 8 for receivables. And receivables is one of the most important assets. It's actually a current asset, and I hope you remember, since it's an asset it always shows on the debit side. So it can be also in the form of long-term assets. So we'll see like different examples of receivables, including accounts receivable, notes receivable, and some other examples of receivables. So the first thing that we're going to start with is that to see how receivables are classified. So the receivables that result from sales on account are normally accounts receivable or note receivable. And when we say sales on account is whenever the business is providing a service or providing a product or delivering a product without getting the cash right away. So we call that accounts receivable, or it can be in the form of a signed document where we call it notes receivable. So the term receivables include all money claims against other entities, including people, companies, and other organizations. Receivables are usually a significant portion of the company's total current assets, especially if they allow this kind of form of business where they provide a service or product on account. Many businesses, they only have cash on delivery, and in this case they don't have receivables. But of course, if you have only cash on delivery, that would restrict your business and you will not be able to make a lot of sales. So this is why many businesses, they accept the idea of receivables. So let's start with accounts receivable, and it's one of the most common forms of receivables because it's usually verbal without any kind of written documentation. So the most common transactions creating a receivable is selling merchandise or service on account, or what we call it sometimes on credit. The receivable is recorded as a debit to accounts receivable whenever we make the sales, such as accounts receivable are normally collected within a short period, normally within 30 to 60 days. In very few cases, it can go up to 90 days. They are classified on the balance sheet as current assets, as I mentioned before. On the other side, we have the note receivable, and notes receivable are amounts that customers owe for which a formal written instrument of credit has been issued. So it's documented in a written instrument. So usually it's a note, and this note makes it more solid compared to just a verbal agreement. If notes receivable are expected to be collected within a year, they are classified on the balance sheet as current assets, very similar to accounts receivable. Notes are often used for credit periods of more than 60 days because people might forget, and this is why they have to document it. So notes may also be used to settle a customer accounts receivable. So in many cases, we have accounts receivable that should be settled within 30 to 60 days. The customer did not pay their balance, so we agree that we're going to sign a note that's going to be paid, let's say, after another 90 days, but this would involve interest. So notes and accounts receivable that result from sales transactions are sometimes called trade receivables. So another name for accounts receivable is trade receivables. Again, tomato, tomato. So other receivables include interest receivables, tax receivable, and receivables from officers or employees. Sometimes the business would provide like advance payments for officers or employees, and they're expected to pay it back to the business. So other receivables are normally reported separately on the balance sheet. If they're expected to be collected within 1 year, so they're classified as current assets, very similar to accounts receivable and notes receivable if they're less than 1 year. If collection expected beyond 1 year, they're classified as non-current assets and reported under the caption investment. So remember that, investment if it's longer than 1 year. So uncollectible receivables is an issue. Most businesses, they make credit sales, and they know that there is a percentage of their credit sales that would not be collected back. So it's part of the expenses for any business, and they anticipate that. But they still accept it because this is a way of enhancing or making sales to be easier. So how are we going to deal with the uncollectible receivables? This is what we're going to be seeing in the few coming slides. So for sales of merchandise or services on accounts or on credit, a major issue is that some customers will not pay their accounts. In other words, some accounts receivable would be uncollectible. That's the other term for it. So if they're not going to be paid by the customers, then we call them uncollectible, or sometimes we call it bad debts. So companies may shift the risk of uncollectible receivables to other companies. That's another way of dealing with these kind of uncollectible receivables by factoring the receivables. So selling receivables is called factoring the receivables. The buyer of the receivable is called a factor. An advantage of factoring is that the company selling its receivables immediately receives cash for operating and other needs. Of course, they're not going to sell it dollar for dollar, but sometimes they can sell it for like 80 cents per dollar. And by that way, they don't need to worry about the collection of these accounts receivable and if somebody's not going to pay and how they're going to collect it and all these kind of issues. So regardless of how careful a company is in granting credit, some credit sales would be uncollectible. The operating expense recorded from uncollectible receivables is called bad debt expense. Bad debt expense, or sometimes we call it uncollectible accounts expense, or sometimes also some businesses use the term doubtful accounts expense. So some indications that an account may be uncollectible include things like the receivable is past due, so we expect to collect it within 60 days. Now it's 70 days and we haven't heard from the customer. Also, the customer does not respond to the company's attempt to collect, or the customer files for bankruptcy, or the customer closes its business, or the company cannot locate the customer because they fled the country or something. So if a customer does not pay, a company may turn the account over to a collection agency. So they give it to a collection agency and they're collecting it on their behalf. So after the collecting agency attempts to collect payments, any remaining balance in the account is considered worthless because there's no way you're going to be able to collect it. So the two methods of accounting for uncollectible receivables are the direct write-off method and the allowance method. The direct write-off method is an easy method, it's very logical. The only problem, it's not accepted by GAAP or generally accepted accounting principles if the business has a lot of accounts receivable. But it's acceptable or permissible if the business has very few accounts receivable. So the direct write-off method records bad debt expense only when an account is determined to be worthless. When it happens, we record it as bad debt expense. So the direct write-off method is often used by small companies and companies with very few receivables. The allowance method is the method accepted by GAAP, and it records bad debt expense by estimating uncollectible accounts at the end of the accounting period. And why we do that? Because we want to make sure that the bad debt expense is recorded at the same period where the sales took place. We don't want the sales to be in one period and then the bad debt expense in another period or in the following period. That's not fair when you're presenting your income statement. So this is why it's required by GAAP. So we make an estimate for what we anticipate to be uncollectible. So as I said before, GAAP or generally accepted accounting principles require companies with a large amount of receivables to use the allowance method. So how does it look like? And let's start with the direct write-off method. So under the direct write-off method, bad debt expense is not recorded until the customer account is determined to be worthless. So when we are sure that this customer is not going to pay, we write it off. So at that time, the customer account receivable is written off. Assume that 4,200 accounts receivable from a customer called DL Ross has been determined to be uncollectible. So the entry to write off the account would be as follows. We're going to debit bad debt expense, and I want you to remember that bad debt expense, it's an expense account. It appears on the debit side like all expenses. And then we credit accounts receivable for DL Ross, and accounts receivable is an asset. We are canceling it or reducing it because of the bad debt. We know that it's not going to be collected, so we record it on the credit side. We are reducing its value. So again, we debit bad debt expense and we credit the accounts receivable, which is an asset. The bad debt expense has a negative impact on stockholders' equity. So an accounts receivable that has been written off may be collected later on. And sometimes it happens, like a customer has some kind of issues, financial problems, and things improved, and now they want to pay back their debt so they can renew their business. So in such cases, the account is reinstated by an entry that reverses the write-off entry. And the cash received in payment is then recorded as a receipt on the account. So we reverse what we've just done, and then we make a regular cash collection journal entry. So at the time when we know that D.F. Ross account is going to be collected, which happened here on November 21st, we have to reinstate and receive the cash. And the reinstatement or the reversal entry, we're going to debit accounts receivable and we credit bad debt expense, which is the opposite of what we've done when we were writing off the debt or the accounts receivable. So you see here we reversed it, so we are bringing back everything as if it never happened and as if we didn't cancel it. And now we're making the collection, so we debit cash and we credit accounts receivable. We debit cash because cash is increasing and it's an asset, so it goes up on the debit side. We're canceling again the accounts receivable because we collected the cash, so we're going to credit accounts receivable for the $4,200. The direct write-off method is used by businesses that sell most of their goods or services for cash or through the acceptance of MasterCard or Visa or any form of credit cards, which are recorded as cash sales. In such cases, receivables are a small part of the current assets and any bad debt expense is very small. Example of such businesses are like restaurants, convenience stores, small retail stores. They usually, the form of credit they offer to the client is through the bank using the credit cards, but they don't handle the credit themselves. Now let's see the other more acceptable form of writing off the allowance for or writing off the bad debt, which is the allowance method for uncollectible accounts. And this is the method that is acceptable by GAAP, and usually it's done when we have a business that has a large value of accounts receivables. So the allowance method estimates the uncollectible accounts receivable at the end of the accounting period. Based on this estimate of expected credit losses, bad debt expense is recorded by an adjusting entry. So at the end of each accounting cycle, we have to think how much we anticipate to be our bad debt expense, and we record an adjusting entry at the end of the year. So let's see this example. Assume that X Stone Company began operations August 1st, year 1. As of the end of its accounting period on December 31st, X Stone has an accounts receivable balance of $200,000. This balance includes some past due accounts. X Stone estimates that $30,000 of the December 31st, year 1 accounts receivable would be uncollectible. If you do the math, this is about 15% of their accounts receivable. So 30,000 out of the 200,000 are not going to be collected. That's what they estimate. So on December 31st, they're going to record an adjusting entry for the amount of uncollectibles. So therefore, the specific customer accounts cannot be decreased or credited. We are just going to create an allowance for doubtful account, which is a contra asset account. And this is going to be credited for the estimated bad debt. So let's see how the adjusting entry would look like. So as you can see here, it's on December 31st. We're going to record bad debt expense, even though we didn't experience any bad debts yet, but we recorded in anticipation of this. And again, why we're doing this? For the sake of satisfying the matching principle. We want to record the bad debt expense in the same period where the sales took place. We don't want to record it in year 2, where the bad debt expense would be an expense related to year 1. And that would not be correct. So the right way to do it is that you estimate how much your bad debt expense, and in this case we estimate $30,000, and we create a contra asset account called allowance for doubtful accounts on the credit side. So allowance for doubtful account, it's an account that relates to accounts receivable. It's a contra asset, so it relates to accounts receivable. It's recorded underneath it with a negative value. And because it's a contra asset, it has an opposite nature to asset, so it has a credit balance. So we expect that it should have a credit balance. And we have here that's just a brief note that says uncollectible accounts estimate. So we debit the bad debt expense, and this is going to be negatively impacting stockholders' equity. And we have the allowance for doubtful accounts under assets, but it's a contra asset account. Remember, it has a credit nature, and that's why it's under assets. So the preceding adjusting entry affects the income statement and the balance sheet. As you can see, we had the bad debt expense and we had the allowance for doubtful accounts. So on the income statement, the $30,000 of bad debt expense would be matched against the related revenues of the period. On the balance sheet, the value of the receivable is reduced to the amount that is expected to be collected or realized. So this amount is 170, which is the 200,000 minus the 30,000, and we call that the net realizable value of the receivables. So we have to present the accounts receivable in full value, which is the 200, and we subtract from it 30,000, which is allowance for doubtful accounts, and the net value, we call it net realizable value for accounts receivable. So let me stop here. In the next video, we're going to see like different techniques for applying the allowance method.